Hey, this is Phil with a little post-election update. You know, a lot of you have maybe mixed feelings about what happened in the election, and I'm not going to get into that. It's still a great country, and we're gonna go on from here with whichever candidate was going to win. What I'm concerned about, or what I wanted to discuss with you, is interest rates. We saw a big move in the bond market post-election. Let me put this chart up here on the screen here and walk you through it. So here you can see in the chart, for about a week or so, we were hovering right around the 200-day moving average, which is the blue line that you see sort of angling slightly upward through the middle of the chart. That 200-day moving average has always been a very important line, and on election day, we dropped down below it, and that's just in any election. There's going to be some uncertainty as to what's going to happen with whoever wins the nomination. Since then, the day after the election, Wednesday, we saw a huge drop in the bond market. And that's a result of a really big rally in the stock market. Overnight during the election, the futures market was down over 800 points. And yesterday, the Dow hit within just a few points of its all-time record high. You may ask why. Well, certainly the stock market feels like the new president-elect is a more pro-business stance and is going to help rally the economy through a business-friendly platform, and the stock market likes that. When money goes into the stock market, it comes out of bonds, and that's what we're seeing. And there's more to that than that. As businesses expand and so forth, that can tend to be a little inflationary, and that's what the bond market doesn't like. So, and now the Fed is possibly pulling back on their stance to raise rates in December, which frankly is probably not a great move for the stock or for the bond market, because the bond likes it when the Fed raises rates because it's fighting inflation. So we've got a lot of different forces at play here in the market. Certainly something that each of you that are waiting to lock or know that you're going to be locking in the future may have some concern about. And you know, the fact of the matter is there's not much we can do about this. We got to kind of ride it out and see where this thing's going to level out. I do think there's some post-election craziness going on here, and over the next maybe week we'll see kind of what the market really has in store for us. So hang in there. Know that we've dropped about 150 basis points in the bond market, which means the same rate you could get on Monday now costs 1.5 points more. But you can still get that rate, and or take a slightly higher rate. It's not going to make a huge change in your payment. It's maybe just more of an attitude adjustment. I hope that helps. Forward and share this with anybody that you think might find it useful. And if you have any specific questions, give me a call. I'm happy to discuss it with you and see if I can help you through this. Have a great day.